Hey, good morning, good afternoon. Ramesh, it looks like I can always depend on you to start the meeting with the greetings. So thank you very much. Really appreciate it. Good afternoon to you as well. What happened to the rest of the crowd? What am I missing? Something today? Any important event happening? But by this time, you know, we will have folks joining in. So I'm not sure. Is there any game? I'm not a big into sports. So I don't know if there is any important game going on.
Yeah, I hardly notice it unless it's a World Cup.
Yeah, okay. Yeah, I don't know. So let me make sure that, yeah, everyone should be able to join in. Are you still seeing the content or are you able to, are you still seeing the screen? Okay. Yeah, after this Zoom has like updated it, their client software, there's some controls that I'm still figuring it out. Anyway, looks good then. Cool. All right. Must have kids traveling for summer vacation. I guess that may be the reason. Yes. Hmm. It's summertime. I already did my travel uh earlier in June, but that may be a reason why, many other folks may be late or may not be able to join in. But anyway, so we'll start. We'll wait for another minute and we'll start. Chat will be off after July 14th. Which chat? I think it's a meetup says that July 18th, some meetup chat will be off. So that may be related to the meetup itself. And anyway, I mean, we don't use the meetup stuff. So we don't have to bother about it, I guess. But not this Zoom. We hardly use meetup chat. I don't remember seeing any messages on the meetup chat. But that may be the case. So all right, let me just go through. Okay, so I think last week I forgot to do the intro. I saw some new people. I think that is new one. You attended last week was your first session. So sorry, I skipped to get an intro. But yeah, if you could introduce yourself, what brings you here? What kind of investor you are in terms of, what kind of opportunities you look for. And yeah, anything else you would want to share? So with the name Dad, uh, go ahead, please. If you can introduce yourself.
Hi, my name is Bill Roselle. Years ago in the 80s, I was in trading and investing, and it's been a while. I've done a lot of family stuff since then, and I'm trying to get back into it. So I've attended some of your option seminars and appreciated the value of that, and wanted to join this to get more more fluent and more current, and what current trading strategies are and what opportunities there are on the market.
Okay, got it. Yeah, okay. So Bill Rosell, yeah, that name sounds familiar from the option bootcamp. Yeah, okay. All right. I guess we also did get an introduction from Mike. Mike Jackson. Mike, if you can introduce yourself. Alrighty. Mike maybe a bit shy, but that's okay. All right, I guess everyone else have been around for some time. So let's get going with today's session. So today I want to tackle two main topics. One is talking about AI, and there are a couple of reports that have come out. And maybe I thought I'll combine both of them and discuss them in this session. So that's one topic that we're going to tackle. Other is that's very timely is we had a CPI PPI report out, and there is like different type of inflations that we hear about, and I thought maybe we'll do a quick rundown on all different type of, I would say, inflations, which include your inflation, deflation, disinflation, and shrinkflation, skimflation. So I'll give a quick rundown on. We'll go through that. So that's I guess two main topics I have for today. Of course, we'll look into what's happening on the crypto side, what's on the macro side, and yeah, few any other stocks if you want to look at, we can spend some time over there. But that's it. Yeah, let's make it more interactive. You have questions, hop in. There is no wrong questions, right? There are no bad questions. If every other people also benefit from the questions that you ask. So yeah, any questions are always welcome. So that's I would say high level discussion agenda for today. Okay. All right, so let's get going. As always, anything that we discuss here is only for our education and entertainment. Don't take it as a financial or investment advice. Do your own research. So before I get into the topic of inflation, I was lucky this week again. I think last week I got lucky in one of the trade on Facebook, Meta, and I still don't know how I was able to sell it at such a high price. In a day it had declined, and this week again. So those who have been around for a few years would probably know this stock. This is the stock of Jumia Technologies. I've been in this stock for almost 4+ years, and for whatever, I know probably the reason why the stock started moving up, but it was like up more than 100% in a week, which is and I don't think there's anything in the business has changed that deserves such a high valuation, and yeah, but I would say, I don't despise it. I like it that the stock that you own goes up 100%. We'll figure out any reason later on. But this is the best performing ticker in my portfolio. It's up like more than SMCI has been up this year. So almost like 290% up year to date. So I'll take that gains, right? And but to put in context, even after this gain, it is still down, like say 70% from its all-time high, right? So let's not celebrate it too soon, but I'll take it as long as, what do you say? Make hay while the sun shines. So that's my situation. Too much of a goodness. But in times like these, me personally, for me, it is easy. And when the stock goes down, I don't feel that bad. But when the stocks go high, I get a little more anxious, in when the stocks make such huge moves. So I also tweeted about it in terms of, hey, I'm pretty happy as a shareholder. But the reason that I see where the stock went up was one analyst on Wall Street firm called Benchmark, which I've never heard about before. I know the Benchmark, who's a VC firm, very, Bill Gurley's a VC firm, Benchmark, very well respected. That I know. But who is the Benchmark Wall Street firm? I have never heard about those analysts. Neither I've heard about the analyst who basically started the coverage on Jumia Technologies, right? So that firm initiated a coverage with a price target of $14. And now I realize why the stock has suddenly started to move up before the report came out on 9th of July, right? I looked I mean, there were hardly any details in the report. It was like a common investing thesis that even I have. Uh, for Jumia, it's in Africa. They're the biggest player in Africa. Africa is going to grow. That's going to be the next China after 20 years, blah, blah, blah. Purchasing power continue to increase. I can understand this year, maybe Nigeria is doing better. So Kenya, there are some of their bigger markets, probably will do better. But does it deserve like going 100% in a week? Absolutely not. So that's why I said, as a shareholder, I'm happy, but something smells fishy to me because the stock had started to move up a few days before the report came out. So I'm in quandary. The choices that I have, and these are I guess, every time as an investor, you'll go through this decision-making process. So I thought maybe let's discuss that. Sell shares, right? It's 100% up in 9 days. It's not bad. So one option that you have, and I am going through, is maybe I'll just sell my shares. But what if it continues to go high? Will I miss the rocket ship? Will I have a seller remorse then if I sell it too soon? And specifically at the time when the stocks are still trading at lower than my cost basis is, right? So that's even a harder decision. Will I lock myself into losses if I sell the stock now? Because it's still trading at below what my end cost basis is. Right? Other option, because we deal in options, is sell covered calls. And that's exactly what I did. I always have a covered call on it. And when it started to move up, I'm like, hey, that's too quick, too soon. I sold more covered call. It moved up. I sold more. It moved up. For 3 days, I continuously sold covered calls. Now on Friday, I'm like, what should I do? Okay, I sold more. But I've been selling it and stock has been moving up. So as a shareholder, you might be thinking, gosh, did I lose the opportunity to make money? Maybe I sold it too soon. Maybe I should have taken a strike price much farther away. So that's option number 2. Option number 3 is, hey, against those covered calls that I've sold, maybe I'll sell a put, get more premium, right? But then the things that come into mind, it looks like it's a pump and dump, man. Stock being up without any change in fundamental maybe it's just a pump and dump, and we never know who is pumping it up or might dump it. Then will I be holding the stock because now it's below my put strike price? I have no intention to add more capital to the stock. I mean, I already have reached the amount of capital that I want to allocate to this particular company. Now, will I be forced to allocate more because now I sold a put and the stock has fallen down? There's a third choice. Fourth choice was maybe do a stock substitution. Right? They sell the shares and use basically convert your same deltas using options, right? That will be a better capital allocation, right? I can sell the shares at whatever the high price right now is and gather the same 100 deltas per 100 shares sold. I can basically buy a call, sell a put, and get 100 deltas exactly, so that if stock continues to go, my exposure is still the same, but I got a little more cash available and I can do whatever I want to do with that cash, right? So fifth one, which I was thinking about yesterday, is maybe put a collar around your position, right? Which is collar option strategy is that you basically sell a call, which is like kind of a covered call, but then you buy a put, right? You sacrifice some premium, but then that covers you from, let's say if it's a pump and dump and the stock goes down, hey, you're going to make money. Right? So these are the 5 options that I have. Now, floor is open. You tell me, what would you do? What are you going to do? I'm not going to sell all my shares because, hey, I've been through NVIDIA and then I realized, guys, I mean, I've not sold all shares in NVIDIA. I sold in portions, but gosh, do you know, or in SMCI, that stock was like $120 dollars 18 months ago. Now SMCI is sitting at like 1,000 plus or whatever, 900. It went all the way to 1,200. Same case with NVIDIA. What would you do? That's my question. What would you do in this case? I think the pain of not being, the pain of opportunity loss is real. So Fred says, what about leap year option, $15 at 490 or 225, collect $4.40. So you're saying, Fred, you're saying that sell covered call, but basically go far out in Jan 2026? Let me see, Jan 2026. Yeah, $15. Yeah, it's like, if I get a midpoint, which probably I'll not, so 490 is what it shows currently.
Why wouldn't you just, I mean, me personally, I just probably just put a stop limit. So like if it, drop below a certain price, I'm out.
So saying put a stop loss.
Yeah, just put a stop loss. I mean, you're not collecting any premium or anything, but
Okay, that
something simple. That's what I
yeah,
would
that
do.
is an option. So probably that's gonna be my first stop loss ever. I've never used stop loss in my life. But maybe there is a time to use stop loss, right? There is always time to try something new. So okay. Yeah, stop loss is one wherein, and so the reason why I've not used stop loss is stock could temporarily drop and then go back up. Right. So that's why I've never used stop loss. But yeah, it is an option. Anything else? So I'll share with you in terms of what I've done so far and what I plan to do come Monday. All right. So let me share what I've already done. Right. And this is the stock that I've, like I said, I've been tracking it from business side. I don't want to get rid of the stock, so I still want to own the stock for another 10, 15 years, or until the business, or until, I've given up hope on the business of this. So let me just bring up because I did document it. What am I going to do? Right. No, so not there. Yeah. So yeah, they've been changing their strategy. So where did I document? Okay. So sell covered calls. Yeah. So I've been selling covered calls against this. So 1/3 of my position, against 1/3 of my position, I have covered calls. Okay. Some of the covered calls are below my strike price because that I've done even before the stock run up. Because I always have been selling covered calls against the position. But after the stock had started to run up, I did covered calls which are higher than my cost basis. So yeah, it will be, the stock will be called away. But at least, I recovered my money and made some profits on those. Stock substitution, I've done for other 1/3 of my stock position. I sold those stocks, and then I basically did a stock substitution, which is you buy a call, get it sponsored while selling a put. So cash outgo is almost nil, and I have a cash available, but then I need to keep that cash somewhere safe so that, if it falls down and I get assigned, and that I've done for uh, January 2026, right? Basically, it's a 100 delta stock subsidy. It's called synthetic stock position. So I have that as a synthetic stock position. Right? Now, but that means I still own the same deltas, but I replace the stock deltas with the option deltas, and the cash that I got, I'm going to use it to, I put it in money market fund, which will give me whatever 5.5%. And the extrinsic premium that I paid was around 4.5%. So I'm like, okay, I can continue to make 5.5%. So that is like completely sponsored by that. Third thing which I'm gonna do is, so far my only delta reduction has been through the covered calls. Now I'm thinking maybe I should sell some stock and raise cash. And on the remaining one, maybe put a collar. So these are the two options which I'm planning to do, is to maybe put a collar against the position and sell 25% of my, reduce deltas by another 10, 15% or 25% by selling some shares and not doing stock substitution, basically just sell the shares. So maybe 1/4 of my original deltas, I'll just sell the shares. On the remaining, maybe I'll put a collar. So that's what I have in mind. I'll see where it goes on Monday. I think this is run up too much too soon. I looked at this valuation and the numbers, did my analysis. I find Amazon is at a more attractive valuation perspective than this stock is. So that's my thesis. Maybe share next week what I did. Owner says, okay, so yeah, I think owner is also new to this group, so maybe we should get some intro. We'll get to that. Owner says simple stop loss is better. Yeah, I'll try that, or simply buy a 6-month put. I am not a favor of just buying a put, because then I have to pay upfront, and that's what I'm planning to do, a collar, because the calls are much more expensive, so I can get a lot more premium to sponsor the buying of put. So yeah, that I do have in mind, is to do a collar. So maybe the screen name owner, if you can introduce yourself. I think you are new to the group. What type of investor you are, how long have you been investing, and what you're looking to get out from our Saturday meeting. You spend 2 hours, so I want to make sure that it is useful, and for this session is useful for you. Oh, monitor has no speaker. Oh, okay, no microphone. Alrighty. Okay, so maybe if you can type it, that'll help. Yeah, so that's it. I feel like I just got lucky, so I don't want to get into the delusion of that I had some insider information, or I knew that it's gonna run up so much. I guess I have my own thesis on the stock. That's why I've been holding the stock, but this one was plain luck, damn luck. Okay. Tesla, other question on Tesla. Would it be stupid to trim some Tesla here? And but in fact, this I had put on Twitter just before, I think a day before they moved out the robo-taxi. So I guess it was the right time to trim Tesla. I guess maybe I became lucky in this one also, because I did trim little bit, because it was up 45% in 11 days just on the hope. Right? It was just a hope that on 8/8 robo-taxi, Elon is going to show some magic. But I still kept the same delta. I just rolled up my put spread, sold some share, rolled up my put spread, kept the delta same. But I guess, again, probably damn just got lucky, because next day, Tesla moved out the 8/8 unveiling of robotaxi. Now it will be in October. This is nothing new. We have, Elon, if you hold Tesla shares, you have to be comfortable with the way Elon works, right? Any deadlines that Elon shares with us, add a few months, or if it is a new vehicle, add a few years, right? So he has great ideas, but just that the calendar, the timing is really bad when it comes to him. So as long as you understand that and position your portfolio accordingly, you should be good. So that was my second stroke of luck for this year. Anyway, so I don't know how long this luck will go, but I'll take it if it comes. Other interesting one, I just came across this picture, and that's why I tweeted, is games that accountants play, and why as an investor we should learn or have little knowledge of bit of an accounting. We don't want to be CPA. we don't want to be a financial analyst. I mean, fine if you want to be, that's a additional bonus. I am not. I don't think I have a even capacity or capability to be a financial analyst. But yeah, I would like to understand at least, read the balance sheet, P&L statement, cash flow, make sure I can understand the high level of how this works. And when the CFO comes and talks about our EBITDA has grown by X%, you also know, what involves is EBITDA or what's the reality may be. So this was an interesting one picture I came across, and I thought I can use this for conveying the concept of the difference between EBITDA and net profit. Could sometime be, how the difference between the two emus are. Little bit fun. Or says two big gaps from FOMO. So I think one is Tesla. Which is the other one? Did I Tesla had yeah, and I'm sure all those the call buyers on Tesla probably are still nursing from the whole gap down in Tesla. What was the other one? Anyway, Broadcom, AVGO. When is AVGO gonna split? Because like $1,700, they did announce a split, right? I don't own the stock. Oh, I don't own the stock, but if I recall correctly, I think they announced a split. 715. Oh, so come Monday, so it'll split. No, I mean, after the earnings, it came back up. Now been consolidating for last 3-4 days. So maybe that'll give me some opportunity if I really want to open position to sell some. Okay, yeah, there is a 10:1 split on 715. So maybe now start selling maybe some put contract on Broadcom. Yeah. Other two things I came across was a couple of NGOs or non-profit organizations shutting down. One is Women Who Code, and the other one is Girls in Tech. So so these attained a lot of prominence during 2020, 2021. Looks like essentially like a lot of other stuff, a lot of other companies that were kept alive, so-called zombie companies, by the liquidity. Now that lack of liquidity, the drying up of funds has also started to hit other organizations, including some non-profit orgs. So sad scene, but reality is, I guess many of these social causes, and I'm not gonna, I don't want to judge in either way, right or wrong. A lot of initiatives around DEI, around around ESG. So yeah, ESG used to be a big theme of investing in, I guess, a few years ago. Even BlackRock even came up and say they're not gonna, take company public or not gonna take positions in a company if they're not following, whatever the BlackRock considered to be as a baseline for ESG. And last year, or a day, was it last year or end of 2022, like Q4 of 2022, BlackRock said, you know what, we're not gonna basically they retraced back their whole emphasis on ESG. 2022, 2023, we started hearing a lot of things around DEI, largely driven by studies from these consulting companies, McKinsey's of the world, on and the same stuff had happened with ESG, was that the company with a high ESG score is actually good for shareholders in long term. They create more value for shareholders, and that's why the idea was companies should focus on improving their ESG score. Same is the case with DEI. there was a study from McKinsey talking about the diverse board or the companies which are more diverse end up creating more value for shareholders. And hence we saw a lot of companies offering consulting around how you can be, be more diverse. There are organizations who basically sell tools for you to be more for the company to track their diversity, to be more diverse. SEC was thinking about asking for the companies. I think they actually did a ruling for companies to reveal their diversity score. There was an article I read through. I think there are other organizations also who had emphasized that the company should disclose more on where they are in diversity. And of course, BlackRock and I guess Goldman Sachs made it mandatory. I think it was maybe Goldman Sachs. They say we're not gonna be your lead manager for IPO if you do not have at least one diverse board member, right? All that happened. Eventually, if you look at the reality, there is the companies with a more diverse board members are not outperforming. The companies that outperform even may have more diverse board members, but that's correlation, not causation, right? And I think it's 2 weeks ago, 3 weeks ago, looks like the McKinsey study, the study that McKinsey did, actually there was not completely honest. There was some fault in the way they had conducted the study. So in the end, I've seen many of these initiatives which are good from social perspective, but really, I think that the whole emphasis is gone when we try to mix correlation with causation. Is it a good thing to do from a societal perspective? Yes, and we should do this, but let's not propagate saying, hey, doing this helps companies financially, right? That's not the case. So, but why do we see that the financially successful companies are more diverse board members? Because they can afford to take a hit on financials and do the things that are good for society. So yes, we must do these things. Yes, we do want to have more women in tech. We do want to encourage diverse board member because that does bring up diversity in thought. But let's not fool ourselves into thinking that that's going to raise the financial profile or the profitability of the company. There is no there is no causation. There is no relationship between these two. That's what now we are coming to that realization, right? So anyway, I saw a couple of them shutting down, and I was like, gosh, if the companies that have been funding these initiatives were in a wrong impression, so that it's going to help them in increasing the shareholder value, then yeah, it was a bad step to even to begin with, right? You should have done and should have conveyed the right message that it's the good thing to do for the society, and hence, even if you have to take up some cost in doing it, we should do it. So that's all. That's a message. But yeah, I'm little very skeptic about any of these new 3-letter initiatives that we see being only people that make money are the consulting companies. These things are beneficial for the consulting companies, and of course the society benefits. But I'm only talking about the financial benefits. It's the consulting companies or the companies that will sell you certification courses on these, the lawyers that will benefit by, if you incorporate it as a law saying you have to declare these things, and if you are a public company, you have not declared it, there'll be a battery of lawyers going through your filings and say, hey, you missed this, right? So those are the, I guess, the entities that have financially benefited from these 3-letter governance or social initiatives, call what you may. But yeah, there was an interesting article in Barron's if you want to go through that. Aditya says, my ESG fund seriously underperformed S&P 500. Yeah, so you should not invest in ESG for financial gain. You should invest in ESG company because they are doing good for society. And it's a good motivation, and there's a right motivation for investing, right? Let's not fool ourselves into thinking, and that's what the consulting companies have been done so far is, hey, it's good for XYZ, when it is actually not. So that's I guess a message. So Aditya, you want to invest in ESG? Great, but let's make sure you are doing it as, and take it as a cost of my doing business, because I do want to promote those concepts. Now, as for me, I don't want to invest into cigarette companies, even though Altria is one of the best performing companies on the stock market, if you include dividends, right? It's been a great company. So I'm missing out on opportunity cost. Yeah, but it's okay. I do not want to invest in cigarette company. If Juul had become a public company, I would not have invested in Juul, because I don't want to. But I don't want to fool myself saying, hey, not investing in Altria is good for my portfolio. No, my portfolio probably would have done better with Altria, but I have my own, thoughts around it's not good for society. Proven ROI will determine quality of a material. Yeah, exactly. So, and yeah, so that's I thought I'll share. I saw two of these non-profit organizations shutting down, and that's bad. That's bad. But if you got into sponsoring these non-profit organizations, thinking it will benefit your company financially, we were chasing the wrong goal, I would say. All right, let's talk about the couple of price indexes that were released this week. We had a CPI that was released, and by God, what the CPI did to the market was amazing. Never seen that stuff happening. At least I've not seen that stuff happening that happened in the market on Thursday. Right? So what drove that? CPI declined 0.1%, 100 basis point in month over month. So it was unchanged in May, and then in June it declined 0.1%. Expectation was that it's going to increase by 0.1%. So we actually beat expectations, and it declined by 0.1%. And year over year, it increased only 3%. So let's not fool ourselves thinking, hey, the inflation, things are not getting expensive. They are getting expensive. Year over year basis, it is still up 3%, right? What drove most of these was gas, energy prices, right? That fell down 3.8% in June, and that was able to offset the more stickier part of inflation, which is shelter, because that increased, right? So not going to go through the whole report, but here's a table that you can find it on a BLS website, which will give you, in case you want to dig into the details. Thing that caught my eye in this table was used cars and trucks was like down 10% year over year. That was the biggest, I would say, drawdown. Transportation services still up. What are the bigger items? That was up like 9.4%. Shelter is still up year over year by 5%. Overall, this is what the 3% a year of year increases. And for June, you can find in this table, was down 0.1%. And this was CPI. Which one document? Hold on. Okay. Then on Friday, we had a PPI, which is Producers Price Index, which actually had increased by 0.2% in June. Now, Producer Price Index is what called as a wholesale price index. This is the inflation that the manufacturers of the goods, they are seeing in their own business. Right? So now some of these, if I'm a business owner and I see my cost of producing the goods is going higher, I'm going to pass off some of those inflation over to consumer. So PPI could also be seen as a harbinger of CPI, a few months ahead in the cycle. It all depends on how much of this inflation can producers pass on to consumers, right? At some point of a time, consumers may say, I'm not paying up for it. But in any case, so that didn't get much of a notice. I think market just ignored it because it was up 0.2%, and markets like I didn't see any concern in the market on Friday. Third thing, which will be, I guess, we are not seen yet, but Fed is interested in PCE, Personal Consumption Expenditure Index. I guess is going to be released in next week or week after next. It will be jiffy before, this starts to, we'll start to see these numbers coming out. But this will be released before the next Fed meeting, which is happening on July 31st. So we'll see what PCE comes out to be, and if that changes any thinking of Fed around the interest rates. So key takeaways, right? And then we also had a unemployment number that also came out. So quick key takeaway was that the inflation is moderating, right? Hey, it is up 3%, but it is less than what it was earlier. So inflation is moderating. Its path is continuing lower. This is the lowest reading since March 2021. Right? Earnings season coming up. Year-over-year earnings is estimated to be, earnings growth is estimated to be 8.8%. So if we see companies not meeting the expectations, I think market will punish them. So right now market is already kind of a price to perfection. They do expect these companies to deliver, not only just to meet the expectation, but to beat the expectation. Meeting expectation means you're not performing. Yeah, that's okay. We've seen it in, I think, in Q1 also, especially some of these high flyers on AI. If you just meet the expectations, that means you're missing the boat. Your stock will be, the stock gets punished. So you have to beat the expectations. So right now, I think 8.8% earnings growth is there. And earnings expecting that is going to grow across all the sectors. All the, 8 of the 11 sectors are expected to report year-over-year growth. So it's not going to, expectation is not that it's not just the tech, but even the other sectors will do better in this quarter. Labor market is showing the signs of cooling, with the unemployment rate is now 4.1%, which is higher than the post-pandemic. I mean, its post-pandemic low was 3.4%. And now it is above Fed forecast of 4% unemployment into 2024. And that is the information that gave confidence to the market that Fed is going to cut rates. And on June, gave more confidence to the market. Now I'm hearing that some economists are even predicting 3 rate cuts, right? So we were 7 rate cuts at June, at start of year at January. We started this year with 7 rate cuts, moved down to 5, then 3, then maybe 1 rate cut. But after this unemployment rate, 4.1%, which is above Fed's threshold. And as you guys know, Fed has dual mandate, price stability and maximum employment, right? Till date, post-COVID, Fed has been focused only on price stability, right? Bring the inflation down. Don't care about other things. Bring the inflation down. Yeah, stock market will crash. No worries. stock market is not Fed's mandate. But as long as the labor markets was still, hot and the unemployment rate was still low, Fed was focused on the other mandate, which was keep the prices low. Now, you kept the prices low. Inflation is now, at the lowest level since March 2021. And now you're seeing that the other mandate, the other side of the Fed's mandate, which is maximum employment, that is starting to hurt because of these increased rates. One way you can now focus on the employment side is by reducing the rates. So that is why market suddenly started to price in, saying, hey, Fed might do maybe two rate cuts. So first rate cut probably expecting in September. So the probability of the rate cut happening in September is now 90%. Right? So here's overall probabilities. So nothing, July. So current rates is 525 to 550 basis points. Right? In July, 94% feel that it's still going to be the same. Fed is not going to cut any interest rates in July 31st meeting. But we don't know, could be wrong. Maybe Fed could use it to cut it in July, but who knows? It's a very small. We just had the June report out. Maybe Fed may want to watch it for 2-3 months. There is no meeting in August. So after July, there's a meeting in September, which is now 97% probability that will cut down from 525 to 500 basis points. And then I guess in November, maybe another 25 basis points. December is equal. So neither here nor there, right? But maybe 2 rate cuts this year. We'll see. And the expectation of this rate cut that drove Russell, to the moon, like DJs would say, to the moon, right? So what happened on Russell or ETF of the Russell IWM? So IWM was more than 3% after the CPI report came out on Thursday. Congratulations to those who hold IWM. And surprising thing was SPY, SPY, as well as Qs. They were both down by more than 1% on Thursday. So the thinking was, is the great rotation happening now? Rotating from high growth, which is what QQs and the top SPY companies are. And are we moving towards more value-oriented companies represented by Russell 2000? That has got a lot other companies as well, right? So that was a big question. And it's only, I think, second time. No, it's only third time that it has happened. I guess the first time I was listening to some podcasts where they were talking. So don't quote me. This is not my own research. But that first time it happened that IWM or Russell was up 3% and the SPY was down more than 1% was in 1970s. Second time it happened was in late 1990s. And then I guess third time is this. We've never seen. So that is why I said at the start of the session, I've never seen this in my investing life. So, but things do happen. But looks like that rotation was only for a day. On Friday, we came back up roaring on QQs and SPYs. Of course, IWM was also up on Friday. So I think Friday was that was like everything up day on Friday. But the only now this IWM goes up because there are many companies who will benefit proportionately lot more by rate cuts than the companies in SPY. Google is not waiting for rate cut. Apple doesn't need rate cuts. Neither does Microsoft or any of these big companies, right? Who need rate cuts? The companies that have, much higher debt on their balance sheet, and now the debt, they need to roll up the debt for the next cycle. If you now have to roll the debt at 5%, you are dead, right? So those companies who need continuously debt to survive, or I shouldn't say only survive, because there are companies who will just take on debt as a financially prudent method, like AT&T, $125 billion plus debt on their balance sheet. But AT&T is not in like a small and medium size, but generally small companies will have a higher debt to equity ratios as compared to some of the big companies, and those companies will benefit from the rate cuts. So remember, we had a discussion, what was it, last week or prior to that, where I was like, should I even have IWM in my portfolio? The thesis being investing in IWM is you get these bumps up when the rate cuts start to come up, and you get these initial bumps. And once I think the rate cuts are implemented, after that, once it's stabilized, then it doesn't do anything much, right? So I'll see what I have to do with my IWM position. Of course, I'll take advantage of this rate cut, and then I'll see whether I want to keep IWM or not. But hopefully Tom Lee's prediction might come true. Now he has now talked about his prediction, which he did at the start of the year, saying IWM or Russell will be up 50% for the year. Right? Where is Russell? It's 6.83% for the year. But yeah, everyone like Tom Lee is God right now, because his prediction of 2023 came true. So this year he's God. 2020, Kathy Wood's stocks did well, ARKK did well, so she was goddess. And now for last 2-3 years, her stuff hasn't worked. Nobody talks about Kathy Wood anymore. Now the Twitter is like spewing venom on Kathy Wood, saying, oh, ARKK is like underperformed, is back where it was 6 years ago. Right? But anyway, so these are you get heroes for the season. Every year there'll be one hero that will come up. One day my dog will be hero, because given enough time, everyone's prediction will come true. So don't pay too much attention on what these analysts say. Okay, so look at your own portfolio, see how you want to, don't pick IWM because Tom Lee says that's going to be up 50% this year. So you don't know when Tom Lee will stop being right. I've seen many analysts who were crowned the analyst of the year, and the next year they just lost their jobs because they were horribly, horribly wrong. I'm not saying Tom Lee is wrong, but all I'm saying is no one knows where the market will go, how the market will behave. But every once in a while, someone's predictions will come true. And then we as an investor make a mistake of putting those analysts or fund managers on pedestal and worship them like gods. It's not Cathy Wood's fault. It's the fault of ours who think Cathy Wood was god of investing. Okay? So that's the message. There is a prediction that rate might go back to 70s or 80s highs or 10 to 12%. No, I don't think 5 to 6%, but I think now what market participants are saying that we're not going to go back to zero. I think that is being priced in, that we're not going to go back to zero. Now the stable rate is going to be 2% or 3% or 4%. Between 2 to 4% is at least what I've seen that economists are talking about. But yeah, maybe 2%, 3% is what I'm thinking would be our standard, stable, steady state rate. Going back to 0% is not going to happen anytime soon. Whether it's going to be 5%, 6%, Howard Marks think that's going to be 5%, 6% or higher. I have not seen any other investor or economist talking about that we're going to go back to 5-6% era of 5-6% rate. I mean, that's given the way our economy and the companies are structured, we will have a bloodbath. We'll have a lot of cleansing to be done. Right? I don't think we are in a position, not only with us, I think overall, it will become much more expensive across the world. So I don't think 5-6%, but yeah, 2%, 3% will be a steady state rate. IWM, a group of zombie companies, comment from owner. When economy is getting slow, they're the first one to go out of business. Yeah. I mean, there's a lot of mortality rate in IWM. And the worst thing is once a company become big enough to survive for a longer term, they take them out of IWM and becomes, it goes out of IWM. So that's that's the concern that I talked about. I have on IWM is once it start to bear fruits, those companies move out of IWM. So the only investing thesis on IWM is when the Fed is trying to cut rates and we'll have a good liquidity. There's a huge call option volumes in IWM. Let's look at option stats. No calls and puts. I think this is the Friday stats, I guess. 2.7, 1.87. Put to call, not too bad. It looks like the puts have been decent. Puts also have traded. At least on Friday, I don't see that. But maybe if we're talking about looking at an open interest, I don't have open interest out here. Let's pick up open interest. Volume open interest. Which side? Yeah, here. Okay, October. Yeah, I see like huge open on the call side, 50,000, 23,000. Maybe go further down. No, but August has got a lot. Sorry, October has got a lot more call volume. Well, let's look at the August one. 25K, 65K. Yeah, so there is a lot more volume and the open interest on the call side than on the put side. Dave says, you like probability cone better than regression channel? I've not used regression channel. I don't have, probability cone just tells me, just looking at, okay, what's my 16 delta movement, right? So I've not used regression channel, so I don't even know, if that is better than this or not. So, okay, high volume, high open interest. Okay. Yeah, you could do that. You can or create your own label with whatever you want to focus on and then use that as a chart in your watch list. TOS is very flexible. That's why I like TOS in terms of you can create your own study or put your own label. Like I've been adding a few more labels now. I had YTD year to date along with my chart. We added a drawdowns, max drawdown, current drawdown. So as and when I get some time, I will, add some more information. It's helpful for my option day trading. Yeah, I'm not a day trader. So, so I don't know. If there's something new that I want to pick up, which I think is going to help me, yeah, I'm open to it. So this week I spent a bunch of time in trying to, and probably we'll see the fruit of that labor maybe later in the session, in trying to understand the companies. There are things that I had in my mind, but I never been able to put together so that it's easy for me to get that information. But I spend bunch of time, many hours this week in trying to do that to help me in investing. All right, so inflations. Let me ask you. We are already 11, halfway through. So I'm not sure if we'll be able to go with both. So shall we do AI report first, or shall we go through all the inflations? I thought we'll do inflation because it's very timely. But then I also want to make sure that we go through AI and we have a time for any Q&A and other stuff before we, okay. Inflation report sounds better. It's not a report, but it talks about what different kinds of inflations we deal with. There are different terms. And yeah, I've heard these terms, on and off, but then I thought, let me also put together in a document. ChatGPT helped me in this one. And so I thought maybe I'll go through various terms. Let's quickly run through it. I'm looking at 11:04. Maybe I spend 10 minutes in going through this one. Okay. Inflation, I guess everyone knows inflation because we are the victims of inflation. It is a gradual loss of purchasing power. Prices of services and goods are rising, right? What's the different causes of inflation? Increase in the supply of money. That's the causes of inflation. For example, printing and distributing money to citizens. We had the stimmy checks. Remember 2020? It's not that far back in history, 2021, right? If you fell into whatever certain income limit, you would have received that stimmy checks. Legally devaluing or reducing the value of your currency. Venezuela, Zimbabwe, even India have devalued their currency. China has been doing it. Loaning new money into existence through banking system. That's where the fractional banking come into picture. So banks will go ahead and loan it. And then depending on the reserve requirement, Fed can help banks in increasing the money supply. Purchasing government bonds from bank. This is what we generally refer as Fed's balance sheet. Now Fed balance sheet is $9 trillion, right? It is because Fed has been buying treasury bonds. And other factor is supply bottlenecks, which is, I would say, some part of the inflation post-COVID was because of the supply chain disruption due to COVID. You wanted to get a car, there were no cars available, no chips available. So we saw the used car prices, new car prices shot through the roof. You have to pay markup on the MSRP. Forget about discount. Markup on MSRP if you're buying a car. That was because there was a supply bottlenecks. We did not have any chips. All the chip capacity was used to produce chips for laptops, right? So these are the various causes. Impact, we know it's a loss of our purchasing power. Any money sitting in a bank is being eaten by inflation, right? It's still the same dollars. It's still the $100 or $1,000 that you have in your bank account. Probably bank account is paying 0.01%. So at the end of a year, you will have $1,000, $1,001. I don't know whatever that 0.01% is, right? Whatever, maybe some cents, but you'll not be able to buy the same amount of goods that you were able to buy at the start of a year because of inflation. It drains down our purchasing power, right? So other second term around inflation is deflation, which is actually when the prices of goods are decreasing. It's like if something cost me $1,000, a year later, the same basket of goods is costing me $950. That is called deflation. It's like contraction in the price of goods and services. Now, how can a deflation happen? Reverse the examples of what we are seeing in inflation. Reduce the money supply, right? Restrain the growth of credit, and hence you will reduce the demand, and which will cause money supply, cause a reduction in money supply. Benefits as a consumer, you benefit because now you can buy the goods at a cheaper rate. But if you're a borrower, then we have a problem because now the value of money has gone high, and whatever you are as a borrower, you have to pay the same dollar amount, right? So the net value of what you have to repay is going high. So in case of an inflationary economy, which is what we have, it's better to borrow. And I'm not coming up promoting that you should borrow for everything, but just from an economics perspective, look at, you borrow some stuff as $100, right? And if you're paying 3% interest rate on it, At the end of a year, you pay $103, but the value of that $103 is even less than $103 in nominal term, right? Because the purchasing power is eroded. So it's better to maybe borrow and extend your outflow later when the value of money is actually less. Right? That's why we see borrowings going high, because you can repay it later when the value of money is less, and you're borrowing it when the value of money is high. So that was deflation, right? Which is the rates, the prices of the goods is decreasing, right? Overall in economy, I'm not saying deflation. It's not, because this means that GDP is actually not growing. GDP is going negative. I've not been lived in an economy where we have a deflation, but I guess we want to keep some 2% inflation rate, right, to keep the GDP growing and keep an economy healthy. Disinflation is what we are going through it right now, which is the prices are still increasing, but the rate of increase is less. And politicians will twist this particular term and saying, hey, look, I brought down the inflation, which is great for consumers. No, it is not. It is good for consumers, but still I have to pay higher prices. But instead of paying $105 for the same amount, I'm paying $103 for $100 worth of goods that I was able to buy a year ago. So that is called disinflation, which is temporary slowing down the pace of price inflation. Now, deflation we have seen in pockets, right? We have seen deflation in electronic goods because the electronic goods have actually become cheaper, right? But overall on economy, it's a disinflation that we are going through right now. I've not seen being in deflationary economy. So disinflation occurs when the inflation rates reduce marginally over short term, which is what we are seeing right now. Every month if not month to month, but year over year, we are seeing that the inflation rate is coming down. CPI came out, we are now down to 3%. Right? We were what, 6%, 9% immediately after COVID, but now down from 9% all the way to 3%. Doesn't mean that the goods have become cheaper. You still go to grocery, you still pay, your bills are still higher than what it used to be pre-COVID. But then the pace at which you have to pay higher amount, that is slowing down, right? So what triggers, monetary policy, tighter monetary policy by central banks? This is what we are seeing. Keep the Fed rates at 525 basis points. That's a tighter monetary policy. Contractions in the business cycle, we haven't seen that yet. And hopefully, Fed will be able to avoid it. I don't want disinflation because the recession is happening. Right? We don't want that. And of course, market dynamics, which is what we have seen, let's say, in electronic goods over years. There are some pockets in some areas, some markets, you can't raise prices because the competition is so high. So you will basically have to reduce the prices. That's disinflation. Yeah. I see a couple of comments. Let me go through that. Hi, Vivek. How do I get access to the recordings? The recordings are on website, Maurice. So once you log into the website and go to, says members, and under that heading, you will see weekly webinars. So you will be able to see on the website. Wages in tech have come down 15% from 2022 and inflation going up. So in IT side, IT companies are going through deflation. The cost of the wages for the IT companies are actually coming down, right? But if you are in a tech sector, it's a double whammy, like Sachin, you're right, Lisa, it's a double whammy My wages are coming down and I have to pay higher prices for the goods. Fred says, same happened after .com. My salary dropped in half. Yeah, exactly. We have seen these cycles, right? Everyone, including the companies and including the employees, we were drinking from the same Kool-Aid of liquidity and charged and whatever salaries we wanted to get. Did we all deserve that amount of a salary? I think if you maybe do an honest introspection of around that time, maybe probably not, right? But reality will set in, and now because there is a fierce competition with Chat GPT, and I really feel that companies are not. So there was another chat. I don't have it here, but I think there was a chart that I looked at wherein the companies that are laying off people and the reasons that companies are providing, let's say it's not because of generative AI, it is because of uh, technological advancements. I'm like, and when I read that report, I'm like, yeah, it is political and it's politically bad to say that I'm laying off people because I'm using AI. So you can't say that, but that's exactly what may be happening. Especially in the software development, man, that's the one area which AI has conquered really, really well, generative AI. So I'm not in the core software development, but I've been heavy user of Google Sheets and Excel using the scripting, etc. The time, what used to take me week, now I can get it done in a few hours using ChatGPT. Right? So I can only assume and see those who are real programmers, if they really, start using ChatGPT or pick up whatever. I've been using ChatGPT as a tool. Gosh, I don't need the same number of engineers anymore. The reason this year I've done a lot more on the TOS side is, I pop in my requirement on ChatGPT, say this is what I'm planning to do in TOS, and it'll spit up the code for me. If it doesn't work, I'll tell this is not working. This is the exact issue I'm getting. Do that with your scripting on Google or on VB script on Excel. It works just fine. Even for your formulae on Excel, it works great. It used to take me almost a week going through different stack exchanges, trying to stitch together all the formulae, look at Stack Exchange, look at MrExcel.com. It's a great, gentleman who has a good community. Look at YouTube, look at some Reddit posts. I don't have to do that anymore. So huge productivity increase, and you done same in the software, right? So not surprising. I'm not surprised that we are seeing the layoffs in the industry, even though they don't attribute it to generative AI because it is politically bad to do it. It is driven by the efficiency gains that you can derive out of these generative AI products. I have no doubt about it. Oh, owner says like a background picture. Oh, thank you. Yeah, I think I found it like 3 weeks ago. I found this picture. Windows, if you have Windows laptop, they'll change the background picture every day. So I'll snap one from there. Okay. All right, let's continue on the inflation side. So shrinkflation. Shrinkflation is reducing the size or quantity of a product while keeping the prices same. So we've seen shrinkflation a lot also in 2023, and even now in 2024. So whatever 16 ounce of chips packet has been reduced to 12 ounce of chips packet, right? So
The Chipotle stock got beaten up, and the complaint was that they had shrunken the portion sizes.
Yeah. So people, I remember people, and there was like Twitter was up in arms against that. Folks will go and take a video of the Chipotle worker when they are actually filling your bowl.
Yeah.
I mean, I feel bad. I mean, how low can you get in
Yeah,
to
instead of
start recording
increasing the
people.
price, just to
Yeah.
put the portion size low. Yeah,
Yeah,
that's
exactly. Yeah. So I always, if I feel it's low, I'll ask them, can you add a little bit extra? And they'll do it. But anyway, so that is what the shrinkflation is. Your Lay's chips bag is of the same size, but it's got more air in it. And if you look at the label, it'll probably tell you that, oh, the amount of the chips has gone low, right? Or if you're buying a shampoo, maybe more portion of the bottle is now empty. So that's called shrinkflation. You shrink the amount of the goods that you have in the same packaging, right? The chocolate bar used to be 100 grams, now it is 90 grams. Price remains constant. So you don't really feel the pinch. How many times have you gone back, looked into the back of our chips packet to see how many ounces of chips are in there? Almost none, right? When I go to the shop, I only look at what size I want, right? This big size or this big size, right? I don't really look at how much is inside it. Uh, so that's called shrinkflation. Reasons is, yeah, higher production cost. PPI increase. Either companies can increase the price of the goods, same goods, or they can keep the price same and give you fewer amounts of the good so that they can also maintain their margins. So that's called shrinkflation. It may sneaky, it is not illegal, as long as they declare it on the label, right? You can't have 16 ounces on the label and put only 12 ounces, right? That's illegal. But how many people actually go back and read the labels? I don't read the label, right? Oh, that's yeah. Because and we don't notice the small reduction in the size. It's only after you open the packet and say, what? It's not full up to this, you know, it's like less. So that's called shrinkflation. Dave says lawsuits with CMG, WMT for changing prices at the register. Okay, so I've not, because I always get, I've not been a victim of this. I see whatever's, I mean, CMG shows you the prices right over there on their board, and which is what we pay. But and that itself has gone higher. And cereals, chocolates, same box, less quantity, same price. So in short, price increase. Yeah, a different way of I think taking money from customer. Next one is upflation. Right? What is upflation? This is a new term that I heard. So basically, the upflation triggered the whole thought process of, let me go through this all type of flations this week, because it was this week that I heard the term called upflation. So I never heard about it before. So what is upflation? It's a new retail trend where the company will increase the prices by creating new applications or features. Right? Not actually, don't they create it? They create in your mind the new applications or the features for the same old product. So I actually heard about it in a podcast, and that's where I thought, okay, let me, just bring it up for the discussion. New uses for the same old products, right? And you see this happening in mostly CPG companies, Procter and Gamble, Unilever, personal care. It's happening a lot more on the personal care side. For example, I think the example that I heard on the podcast was around the Dio. Okay, so I don't know which company is it, P&G or Unilever. One of these CPG companies have come up with all body Dio, right? So Dio generally use at more more sweaty areas under your arms and very specific areas. Now they're talking about all body Dio, and they'll you can use it at wherever you want on your body, and then they are basically, the goods is the same. Now the package is indifferent, and they're charging you higher prices for it. So that is upflation. Same stuff, maybe packaged differently and sold to you is a different use case, which is, hey, now you can use it for maybe more stuff, and hence you have to pay me for. Right? So that is called upflation, and they use this to justify the higher prices because, hey, now you can use it for more purposes. Even though whenever, let's say, prior to this, the new advertised use, you could have used the same deodorant anywhere you want to on your body, right? Who cares?
I mean, simple example like toothpaste, they want to use more and more quantity. I mean, it'll not get more whiter if you're using a bunch
Yeah.
of stuff. But you'd say the same thing with Apple phones. I mean, they want people to buy newer phones faster. The cycle is slow. Now, adding more AI features and all that bells and whistles will help people buy more phones faster. 2000
Yeah,
bucks.
so Apple stuff is like, that is what the upflation, it is upflation. It's I wouldn't say completely, because they actually do change the stuff.
Yeah,
Apple is not that the same camera, and they will improve the camera a little bit. Right?
absolutely. Yeah.
So I don't think that's upflation. Upflation is when you have the same stuff, just
Mhm.
package it differently and tell to the consumer that it is for a different use case as well.
Gotcha.
Okay, so that's a slight difference. So, for example, there was another example. I think I was reading through it. There is a new razor. I mean, it's not a new razor, but the company is promoting it as now, you can use this at other tricky areas of your body. You can figure out what those tricky areas are. But they say this one won't give you, any nicks or cuts on those tricky areas of your body, and charging higher prices for it. It's the damn same razor, right? Now they will package it differently and sell it to that you can use it at other areas of your body also. So that's another example of upflation. Oh yeah, that's called as okay. So I have it here, right? The whole body deodorants and called intimate razors. It comes at like $5 markup for regular razors. So when I the other example which came into my mind was, I don't think it's exactly upflation, but I always used to wonder when the companies like Gillette came up with the, like 20, 30 years ago, they came up with their Sensor XL with the twin blades, right? That was my first time when I graduated from, I was in India, and now I'm probably talking my age, but I started, my first razor I used was actually a razor blade. I don't know. Probably you guys may not even, most of you may not even know about that. They got a twin sides. You actually have a sharp edge, and you basically put that actually razor blade. If I can, like an image of a razor blade. Let me just pull this. Right. This is a razor blade. Right. I've started with this. I started my journey with this. And when you get you got Gillette's Sensor XL with a twin blade system, I'm like, wow, that's great. Now you got a two blades. When you're doing shave, you got a two blades, you got a better shave, like deeper cuts. And then that's what I started. And then you got triple blade started to come in. And I used to think, were they like just fooling us? You fooling us earlier, saying you get a much closer shave. That's the closest shave you can get with the two blades instead of a single blade. And now they came up with three, means either they were lying earlier, means two blades was not the closest one, because now we have three blades. Then came four blades, then like five blades, right? But nowadays they got five. So call me whatever you want to. I'm still stuck using the twin blade system. I don't get those blades in US. So when I go to India, my first trip I want to do is to go to a shop and get 20, 30 cartridges of Gillette Sensor XL. Or nowadays, or I'll order from Amazon. But they have stopped selling it in developed countries, I guess, in US and in Europe. But I still like that. And I've never felt a need to graduate from twin blade to three blade or 4, 5, 7, 7. I always used to wonder, did you like, are you telling the truth now? Or, was that, if two blade wasn't the closest one, how do I believe that the three blade is the closest one? No, like 4 and 5. So, yeah, so I'm still on Sensor XL. Harry's is a one blade can last 2-4 months. Okay, I have not used Harry. Harry's got bought over, right? I think Unilever bought Harry's. So they started as a challenger, and unfortunately, this is what happens. Anyone tried to challenge the big ones, and then they got bought over by the big ones later on. Beat Mark III. Yeah, I think maybe I should graduate to 3-blade system now. That's one agenda I have when I go to India is I need to get my Gillette sensor XLs. Anyway, so next one is stagflation, right? Stagflation is high inflation and stagnant economy and high unemployment. This is the worst for economy. Right? Now, if you get inflation, you at least have the economy is also growing, and the employment is hot. Stagflation is where you are getting beaten up by all sides, right? You have a high inflation, economy is not growing, and you have unemployment is also high. This is the worst situation that we could be in, and Fed tries to avoid this situation. That's why now the market is thinking that if unemployment is going high, or at least now we have a controlled inflation, so we don't have a risk of stagflation. But we were talking about stagflation in 2022 because the inflation like 6%, 7%, and if the labor market starts to cool down, that would have led to stagflation, which is the worst situation. So I think we had stagflation in 1970s, wherein the oil embargo led to a sharp increase in oil prices. Inflation raised double digits, and the economy has slowed down because a lot of our economy runs on fossil fuels. Economy slowed down, they had to lay off people. So we got a worst of everything. So that was stagflation. Final one is hyperinflation. Or maybe I think I have one more after that. Hyperinflation is where we see typically exceeding 50% per month. Right? That might sound to us like, come on, never gonna happen. But countries like Zimbabwe has gone through hyperinflation. Some LATAM countries have the same problem, like Venezuela had the same problem, hyperinflation. That's the reason why I think you see $1 trillion banknote in Zimbabwe. I think they have, again, every few years they will reset their currency and start to peg to dollars. So I don't think that $1 trillion Zimbabwean that note is valid anymore, but we can see in the picture, right? Oh, no. You got $100 trillion banknote from Zimbabwe because the currency was worthless. It was like hyperinflation. You would have, you get your salary, and if you don't spend the salary in a day, you're gonna buy fewer goods the next day. So in a country with a hyperinflation, what people do, and I think some of the LATAM country, I read an article earlier that there are like riots when the salary is paid off, because everyone wants to go to the store and spend it immediately, because if they hold on to their salary, next day is gonna bring fewer goods at home. So if you want to go your groceries, buy anything else, the moment you get your salary, go and buy everything. Unfortunately, and you can have a sacks full of currency notes, they become worthless. Right? That's a hyperinflation. Zimbabwe had in 2000s, Germany had in 1920s, Venezuela had in 2010s, right? 10 million% in 2019. We are feeling the impact of like 5-6% or 9%, 10 million%. Zimbabwe at worst 79.6 billion% per month in November 2008. It's like every second the value of your money is going down. Final one is skimpflation. This is very tricky. Probably it could be to some point, maybe if not illegal, it is unethical. Such is extreme theta decay. Yeah, it's like at the last few seconds before expiration, that's like a kind of a theta decay is hyperinflation. Now, skimpflation is the businesses reduce the quality of their products or services by keeping the prices same. Like a restaurant might use cheaper ingredients. Hotel might reduce housekeeping services, right? Now we have seen hotels doing it. You go to a hotel, check into a hotel, they say, now we do every alternate day service. If you want, you have to call them up. Or we will change the towels only after 2 days. They don't do housekeeping every day anymore. But the prices have not come down. Just that the quality of the service has come down. A restaurant, like I said, might use cheaper ingredients instead of the best quality ingredients. So that is called skimpflation. Airlines reducing the number of flight attendants. Right? Skimpflation. I don't know what you call Domino's. Where Domino's says that if you go and pick up the pizza, we'll give you $5. There has to be some name for that also. I don't know what you call that. Hotels eliminating daily, so there we go. Eliminating daily housekeeping service or reducing amenities. Right? Food products, lower quality ingredients, same package, same price, but you have to go back and look at the label of food, what it contains. That is degraded in quality. Right? So that's called skimpflation. Domino stuff I have to figure out. I guess very few Domino has, you can, I never had a pizza from Domino's, but they have, like, if you go and pick up pizza from Domino's, they'll pay you. Flight attendant quantity is regulated by aircraft size. Okay. Maybe ChatGPT, you have to do the homework properly. But maybe they'll reduce the services, right? They don't serve some snacks anymore. Hotels removed microwaves from all rooms and just one at reception. I've seen that as well. Yeah, some of the hotels don't have any microwaves. Anyway, so that was all around different kinds of inflation. If you come across some new term, do let me know. I'll just add it to this whole rosters of different inflations. Market side, we talked about it. Is the rotation happening or not? I thought on Thursday there was rotation. Then on Friday was proven wrong. So this is at the end of a week, right? I guess it's a mixed bag. Some tech companies are higher. Apple closed higher. Nvidia is up like almost 3%, 2.75%. Healthcare is all mostly green. Cyclical, I think, is hurt by mostly Tesla and Amazon. Costco is down 5%. Costco increased their membership rates. It's going to increase by, I think, $10 and $5 respectively for executive and the other regular members. Maybe that's what caused the shares to go down, but I don't know. Shares are super expensive. Costco shares are super expensive. Anyway, it's a great business, but why would you pay, like, I think it's more than 50 times their earnings for a retail company. I don't care how great the retail company may be. Yeah, even forward P is like 47. Come on. Who is buying these Costco shares? So, yeah, you're paying like almost 50 times earnings for a retail company. I agree they are sticky. Consumers, once you're Costco members, you hardly, think of moving away. You keep on paying your membership year after year, but 50 times earnings, still super. I can't wrap my head around it. So to me, it's a no go. But if you held it for long, kudos. Does it give a good dividend? It's what's the dividend yield? Oh, that is why I think, yeah, almost 2.25% dividend. Enjoy the dividends. Anyway, sector-wise, S&P is up almost 18%. It's so difficult to imagine. 18% in 6 months. That is despite growing 26% a year ago. But that's what, strength of economy. And US continues to lead. I mean, there are a few markets, other markets that have done better than US, but largely, I think staying or investing in the US's best companies have been a great strategy for past many decades, despite all the doom and gloom scenarios that we have heard. But US investing in S&P 500, it's yeah, if you don't do individual stocks, it's still a best way to grow your wealth, up almost 18%. There was a questions on what happened to the money on sidelines when we saw growth, when we talked about a rotation, saying when IW went up 3%, that money has to come from somewhere. Where did it come from? Came from the gains that people have made in NVIDIA. They sold off NVIDIA. You sell off Google, you sell off Microsoft or Apples of the world, right? So the question was, the rotation is happening. What happened to all the money on the sideline? We still have $6.14 trillion sitting on the sideline. Right? Retail has got almost $2.5 trillion sitting on the sideline. So what happened to the whole narrative of that, when this money will start to come into the markets should just will go through the roof. Now, Fed is kind of Jerome Powell already gave a hint that they're going to decrease it. It's only a question of time, right? Maybe September. We haven't seen any decline, big decline in money market funds. So what happened to the whole thesis of money on the sideline? This looks like this is not waiting on the sideline to be deployed. Maybe those investors who park their money in money market fund for 5.5%, that is the core part of their investment. And that's probably what we and many of the commentators have missed. Maybe 5% is a part of investing. You don't want to touch that 5% because that is your investment. It is a portion of your investment. So the whole concept of money waiting on the sideline to be deployed and will pump the market up may not come true. We haven't seen sizable decline. Anyway, we'll see how far and how long can these investors wait. If they are really waiting for deploying it, guys, you're already you're 18% behind already in 6 months. And if you go to 2023, you're behind 40%. How long do you want to wait before they deploy it? Unless this is part of your money deployment strategy, that I'm going to keep so much of my wealth in money market funds. To me, that sounds to be better option than, hey, this is waiting to be deployed. Because we are up 40% and still not deployed. So that's our thought on the money market asset. Fear and greed index moved into the greed side. And maybe why not? S&P is hitting new all-time high. NASDAQ hit new all-time high. As well as Dow Jones is at all-time high. We are on all-time high on all the indices. Depending on which pocket of the country you live in, you may not feel that the markets are doing so good because people are being laid off, or the programs, companies have been cutting down on benefits or on programs. But all three markets have it all-time highs, guys, this week. Any other general questions on the markets? We talked a lot. Crypto. What happened on the crypto side? Still waiting for Ethereum ETF. It didn't We didn't see anything coming out this week. So maybe next week. All the issuers have done all the filing. Now they're just waiting for SEC to tell them, is everything okay? Or do they need to make any more changes in it? Bitcoin ETF had taken a lot of cycles. So now issuers are kind of, you become wiser once you do one thing. So yeah, it's just wait and watch on Ethereum ETFs. I think Ethereum ETFs will also be kind of successful when you talk of from an ETF perspective. May not be as successful as the Bitcoin ETFs have been. I mean, Bitcoin ETFs have been the most successful ETFs in the history of ETFs, period. Whether you are pro crypto or anti crypto, but the numbers, we can't. Numbers are true, right? They have been the most successful ETFs in terms of asset under management given a period of time. What took gold, the second best ETF, gold, 3 years to get asset under management? The Bitcoin ETFs have done it in 6 months. So that says something about the success or the eagerness of investors to invest in this asset class. Is it a Ponzi scheme as some say make it to be? Maybe. I don't want to judge that. But people are putting in money. There's no doubt about it. Mostly largely driven by retail investors, right? Fewer, the more $100 million plus trades are far and few. I mean, we have seen earlier in terms of which funds are into this, but still largely a retail play. Ethereum, I expect, might do 20%, 15 to 20% of the Bitcoin AUM. Right? Even if it does that, it's going to be a good ETF launch for the issuers. Right? So that's also, but yeah, I guess 15, 20%. The issuers saying that they have a much wider use case and they will do much bigger AUM, but I think 20% if they do it, that'll be great itself. So Bitcoin seems to be on path of recovery. Last week it was like 54,000 once the German government started to sell it. And how crazy sometimes the governments can be. Not that they are selling it. There are one portion of crypto Twitter which says the German government is stupid in selling Bitcoins. I don't want to judge on that. But even if you want to sell it, the mechanism that they used was stupid. Like plain dumb stupid. I don't know who in Germany has been managing the disposal of this asset. So the way they did was they sent in all this bunch of Bitcoins directly to the exchanges, to Coinbase, to Kraken, and start selling over there. You never do that. I mean, you'll do it if you have 10 Bitcoins, 100 Bitcoins, right? If you got like whatever, 140,000, you're going to crash the market. It's like someone trying to sell 5 million shares of Tesla is going to this TD Ameritrade account and pressing a sell order for 5 million shares. You never do it. You work through the trading desks who then know how to not impact the market and sell it the right way. Because you give a $5 million shares, you probably sell 100 shares the current market price and the price will just dip down because of the large sell order. And that's why, but the Germans, like they just did it like an amateur would sell its holdings, right? Whether it's if you're selling 100 shares of Tesla, doesn't matter. You're selling 1,000, 5,000 shares of Tesla, probably doesn't matter. You're selling 1,000,000 shares of Tesla, you work through a dedicated trading desk. So now I think whatever they sold the half of it, and the remaining half they couldn't sell because the prices had gone so down. I think now they're working with some trading desk. Anyway, so that was stupid of them. So Bitcoin is now on path of recovery. It's back to 58K. This is when in the morning I took a screenshot, and as always with crypto markets are not closed. Stock market is closed, crypto market is not closed, so things could change. It hasn't changed much. Okay, so we are still where we were. So that's a good to see that recovery. I see another question. Can you please share thoughts on holding pension in Fidelity Future Wise Target 2055 as US equity fund? So this target date retirement fund, and I mean everyone has it, Vanguard has it, Fidelity will have it, any decent retirement portfolio will have it. So what they do is, if you tell them that I'm going to retire in 2055, and then they will change the composition of the fund based on your target retirement year. For example, the general wisdom in investing and retirement circles is, when you have many more years to retirement, you go a little aggressive, right? You can afford to take risk because you have a time at on your side. Right? In 2008, 2009, when the market crashed, was the best time to invest for someone who doesn't need that money for next 20 years, 30 years. But it is the worst time to invest for someone who need money in 2010 because they're retiring in 2010. So that's why these targeted retirement funds will make sure that if you are far away from retirement, they will have an exposure which is a little more risky, but will have a more potential for return in a longer term. And as you get closer to retirement, they'll reduce down the risk of equity, add more bonds, add more fixed income, keep more cash, and diversify, in other areas also. So that takes the hassle of you to manage your portfolio, and they charge a fee for it.
Yeah. So Vivek, what was making me slightly uncomfortable about these funds is, even with like whatever 25, 30 years to retirement, I think this thing's holding about 30% or something like that of total assets in bonds or something. So that's what makes me think this might be a really long-term stupid thing. If there's 30 years to retirement, I mean, yeah, 10 years, 5 years to retirement, I understand. But it just makes me think if it's just a real stupid thing I'm doing here.
So yeah, so you preempted where I was about to go. So this is where the funds are meant for. Now, I think I shared a study a few weeks ago where they say, before you pick retirement, read through it to see what they invest in and make sure it matches your risk profile. Because many of the retirement funds are not exactly doing what they you would expect them to do, depending on how far they're away from the retirement, which is the point which you brought. Because by default, if you join an employer, the default selection is a targeted retirement fund. And most of the money is by default getting into a targeted retirement fund. I think that's where there was a study, and I think it was Bloomberg or Barron, somewhere I read it, which says that you should pay attention. Now, let's say, I give an example of general wisdom says, if you are closer to retirement, don't hold equities, right? But now my situation may be different. I want to figure out a way, because to make higher money, because I'm getting into retirement, which is not too far away, and I don't have too much time available. Right? I might have a property where I'm invested in, but that's not liquid. So I may want to pick up an equity-based, more equity in my retirement side than what a target retirement fund may have it. Right? So that's where the whole study was, that even though you may be retiring on the same year, people have a different objectives when it comes to the risk taking or the kind of a return they want from their retirement plans. And hence, go and study what your retirement plan holds. So if 2055 is holding 30% in bonds, I'm like, that is BS. Then I shouldn't be holding targeted 2055 retirement plan. But if it is holding 5%, 10% in bond, maybe I'll consider that. So that's why you need to look to it, because these plans have started to deviate from what they were initially designed to do. Maybe some have become too much conservative, which will hurt you if you're only 10 years away from retirement and you are too conservative. Guys, you're not leaving me any room to make money.
Yeah.
So that's the case.
And with, again, like, I understand the markets are again all-time high today, but considering a time investment horizon of about at least 25, 30 years, it'll be stupid to not completely switch over, right? That's what.
Yeah, I agree. Yeah, I agree.
Right. Thank you.
And you can, like, when it comes to Fidelity has got FX AIX, which is equivalent of SPY 500, and the expense ratio is really, really low. It's even less than SPY.
Hi, Vivek.
Yeah.
Yeah, so let me chime in. Getting close to retirement, and I like tackle my coworkers and everything. We use Vanguard, and like, so let me see what you got invested in. I'm like looking at this, and you're losing money when the market is like skyrocketing, and you really have to manage it. And the Vanguard ETFs, they keep changing it, so you gotta log in and look at the ETFs that you have, and then there's a detailed PDF file. So you gotta go into there and see exactly what they invest in. So I'll give you a perfect example. If you pull out Vanguard TRLGX, and you can see how this thing is doubled in price. TRLGX. That's if you guys have Vanguard. So if you look at the chart, it was down to like 40 something. It almost doubled within like 16 months. So basically, if you go into it in detail and dissect it, it's actually the Magnificent Seven. And that's why it's making big money. So you really have to go in to every single ETF and actually do. So I have multiple cost systems are created, which follows the sectors, follow the ETFs from Vanguard, and follows trend lines, follows how everything's going. So if you really manage it, you can make a lot more money what they give you. So Vanguard, as a rule of thumb, so if you have Vanguard 2065, it's very aggressive. As you get older, it will change everything on it. So if you get Vanguard 2020 or 2025 or 2030, that one is aimed for almost no growth, but to conserve your money. So you really have to decide what you're going to do. You want to stay in the middle. If you look at the Vanguards 2030, 2035, 2045, you look at stats, there's one in the middle that probably gives you overall higher percentage. So you want to look at all the options you have in your 401k or 457, print them out, look at the PDF files, and dissect all the stocks they invest in, and then you get an idea where you're gonna make the most money. So, a quick example: this stock jumped 5.5% in 10 days. So I put my money in about 10 days ago. I put it in. My 401k jumped 5.5%, not the whole year, in 10 days. I made 500% on my 457. So I'm just giving an example. You really need to dissect every single ETF that the 401 company provides you and dissect exactly what they invest in. Go to Thinkorswim, create a watch list for what each stocks are in each ETF, so you can manage it and follow it and see how the trend is. But that's my opinion. You can do your own, but that's how I've been doing it, because I was like losing money in 2022, 23. I lost 50% of my money, and And then when I look at it, this is, oh, this is not good. I'm near retirement. I got 3 years more to work, and I just started my 47. I mean, my 401k, I never had it in my life because I couldn't afford it. So I'm maxing it out. And also, one thing for you guys to know, there's something called catch up. The last 3 years before you announce you retire, you can do catch up, which is up to like additional 20,000. So like this year, if you're 50 plus, you can put about $45,000, which into your into your IRA, which also helps on your taxes. So I mean, if you make 150K, now you're getting taxed at 100K. So you can do this anytime, but you can do it only one time in your lifetime. So just something to watch out for when you decide to retire. Whenever you can use that option, which will help you a lot in taxes, and also put your money in a safe place for later on. But all the companies have one, which only gives you 1%. It's like a cash value. So a lot of people, when they retire, they say, okay, I want 50% of the money in this thing that gives you 1%. It won't go down. It's like secure cash that you can leave it in the system. And the other 50% you can use to invest in whatever ETFs. But that's what most people do when they retire. They'll keep half and half. If the market crashes, at least you have half your money still there as money that doesn't tank. Okay, so that's, thanks for your thoughts. Whatever you want to take it. But go ahead, Vivek. Continue.
Okay. No, thank you for sharing the thoughts. And yeah, you said the right thing, which is look into the prospectus of the document, what that has. In fact, I was having discussion with one of my friend who recently joined a new job. So he called me up saying, hey, I need to do my selections for this 401k. And he said there are a lot of lists. And I asked him, is there anyone on a Vanguard? And they are also through Vanguard. I'm like, which says like market index or S&P, and he found out one and said, but what's your currently very like default choice was again the target date retirement fund. So I asked him, okay, what is the target date? He said, I have no idea. I'm like, okay, we can sit together later, but maybe for now you can do half, put half in that which is mimicking S&P 500, and then we can sit and see what is in your retirement fund. And I know him. I've helped him earlier also in setting up his retirement, the brokerage accounts. All his money was sitting in a checking account. So I said, then we can figure out where and what to do. But for now, do this unless we meet again. So yes, it's important to know what, because these target retirement funds may not exactly be meeting what your goal is, and there are other ways available for us. So good thing is, I like that the companies are at least putting something by default. Otherwise, as an investor, we would have never done it. We would have just kept the money in cash, which is worst thing that you can do, right? Because that is like you're draining the value, your wealth every day, losing out to inflation. So first step is get your 401k, get your regular payments into whatever the default is. Now you're a little more active, like Aditya is asking. Yeah, let's have a discussion. Look into the default one, say, oh, 30% in bonds. God, I've got 30 years to retirement. What am I doing here? 30% on bonds. That is like not even growing because it's a fixed income. You can then figure out, again, instead of that, I'm going to do it in S&P 500. Or whatever, on the emerging market, there will be an emerging market fund. There will be a gold fund. Then you want to become more active. What Fred has done is great, right? He watches it very closely and he moves his funds based on what he is seeing in the market. But then you have to be that active. And this is not everyone's cup of tea. So, but good thing is we have options available at different levels of involvement. Figure out what your level of involvement could be. Now, don't get overwhelmed saying, oh, if I were to do this 401k, I have to watch it on every day. No, absolutely not necessary. Only if you want to. Right? Only if you want to. You can make this investing as easy or as complex as you want it to be. Right? That's the one thing which I've learned here is that you don't have to make it really complex. There are low cost options available, very diversified, etc., which you can pick up. Now today, S&P 500, which used to be the whole idea being at S&P 500 ETF was it's a diversified. It's no longer diversified now. Like out of top 10, 8 of them are driven by the same thesis or same theme of AI. What happens when the AI theme goes down? Right? But over long term, S&P will balance itself out, right? There is always a times when one theme is strong, but if you're having a thesis of, let's say, 20 years, S&P is still good instrument. But if you have a thesis, right now, if you're looking, I need to retire in next 3 years, and all my money is in S&P, I will personally be cautious because now majority of my money, 50% of the profits in S&P are driven by the AI thesis. And it has done great because last 18 months, it's all AI. I have to retire in 5 years. What if the AI thesis fizzles out in next 2 years? In that case, I would want to diversify from S&P. So,
and Vivek, I know we've talked on this for a couple of minutes now, but also love to know your thoughts on geographical diversification. So, any particular funds used to do that? Because, yeah, I'm finding a lot of my investments are starting to concentrate in and around America.
Yeah, so there are country-specific funds that you can trade in, or there are companies that derive majority of their revenue from geographies other than US. My biggest individual stock holding is not in US. That's a Mercado Libre, which operates in Latin. Then I have some Chinese stocks. I have a ETF related to India. Then I have some companies that I hold, which is on a Southeast Asia, and Jumia is Africa, right? I don't have anything around the Europe side, but there is an ETF on Europe that you can pick. I think FEZ. So yeah, maybe some other day we can have a discussion on. We can list down all the non-US ETFs. There's an ETF which says developed countries except US, which will cover a lot of your European countries.
Yeah.
EFA, you can use that. So there are ways to diversify. Over the last few decades, US has still been the best performer, but that doesn't mean that the next decade will be US, right? So it pays to be a little diversified, but if you go too much on the outside, you would have missed all the gains that US had given us.
Yeah, no, totally. And also on the rate of movement time, I mean, with the very long horizon, I'm thinking if I should just do a one-shot transfer 100% from X fund to Y fund, or maybe break it down 1 month to 20, 30%.
So I am not a fan of going all in one shot.
Right.
In that, I have missed the opportunities, and I've also avoided the catastrophic losses.
Yeah,
I'm a big fan of doing DCA over a month. Over a year. So every month you can divide. I'm going to move 8 to 10% from that to the new fund. That's just how I am. I'm not a fan of doing one big swoop of at any point of a time.
Yeah.
Or you can say if I done it in 2020, that would be the best thing. Yeah, but that's hindsight.
Yeah. No, thank you. That makes sense. Thank you.
Cool. All right. So what did I buy or sell? Bought nothing. Sold a little bit of a TSM because my covered call spread was in the money. So I closed it and sponsored it by selling some TSM shares. Overall, the holdings did good. I mean, that's what it was meant for. That if the stock goes high and beyond my short strike price. I will sell some, which I did. Tesla, I already talked about it. I sold some shares when it was like up 45% in 11 days and rolled up the put. Jumia, we already talked about. I did a stock substitution, deposited the cash in ICSH. So that's it from a stock side. Nothing else. AI story, I guess we'll come back next week. You're already over our time. So, but I'll give you a brief on what I wanted to cover. So I'm seeing a lot in the markets. There are many established fund manager or the firms are now starting to talk about AI story may not be as rosy as what we have been thinking. So there are a couple of studies that I've gone through. One is from Sequoia, the famed VC, the most, I would say, profitable VC in the history. And the other one is from Goldman Sachs, the two reports. So I'll give you a summary. We'll go, I think the Sequoia, I'll go through the full, but for the Goldman's, because that's not a big one, that's like a 2-pager. But the Goldman Sachs, I'll give you a summary of it. That's like 39 pages. So next week. All right. One other topic want to address, because this is the question that I've been asked of many, many times. Why not give money to financial advisor? Because, or to a, let's say, Wall Street wealth manager, because they have got access, or why don't I just buy a mutual fund? I think this is more relevant to buying a mutual fund. Right? Why do I need to invest? Why do I have to invest to take care of my investing? Why don't I just buy mutual fund? That's how the trend has been for decades, where the mutual fund industry has flourished. So here's my thoughts on what advantage that as an individual investor you have against the mutual fund managers. First, and this is the foremost one, long-term view. Right? Mutual fund managers, they have, the mutual fund industry take out the rankings every year. They compare the results every quarter, which fund is doing how. As an individual investor, we don't have to worry about it. I'm not comparing my returns with Bobby or Hurry. I'm just picking names, what I see on the participant list, right? I don't have to compare about it. I can really have my long-term thesis. That is why I always tell you, don't follow me, because I may be playing a different game than what you may want to play. I am not right now. I'm not building my portfolio to have the maximum return. I'm building a portfolio to have the longest survivability in case we hit another COVID, etc. Right? I want to build a most resilient portfolio, not the most returning portfolio every year after year. So I will be happy with a lower return, but managing the risk this year. If the market continues to rip higher, you may have a different objective. I don't have any peers to compare with. So I can have a much longer term. I can make a decision with that. Maybe it's like doing as an Amazon, deciding that I'm going to invest into CapEx this year and take a hit on my margins this year, but to make sure my business grows further and goes much higher in the later part of a year, long-term view. You as an individual investor, I as an individual investor can afford to take a long-term view. Many of the mutual funds manager not. The stats will show that you're lagging the industry behind. No one would want to invest with them. Okay. Letting your winners run. If a particular stock does too well, mutual fund managers will have to cut on those stocks, because then the SE will say you're not diversified enough. And I know of a fund where they closed and the fund and returned all the money to shareholders because they were invested in only in 3 companies. And then one of them became a much bigger portion. The question is not, the fund did extremely good because the biggest portion was Amazon. Right? But then regulations were like, you're not diversified. Right? So the fund manager closed the fund. He said, I don't want to diversify it. Right? So, which is like, instead of watering the winners, they will be forced to trim the winners, right? As an individual investor, I'm not saying that you should hold only 3 stocks. pick up 3, pick up 20, pick up 15, pick up 50, 60, whatever you are comfortable with, right? It's not someone else defining for you. Yeah, you can let your winners run. If NVIDIA becomes 30% of your portfolio, you want to hold it because you have a great thesis on NVIDIA, hold it. Nobody is saying anything to you. You won't be able to do it if you are a mutual fund manager. Tax efficiency. And I think I touched upon this topic earlier also. Mutual funds will distribute gains even if you as an individual investor haven't sold any fund, you still might be hit with the tax liability. It is how because some other investors have sold. So this is how the industry is structured, right? So you can decide as an individual investor when you want to control your taxable events, right? Not the mutual fund manager will decide. They don't know what your taxable situation is. Maybe you got a decent amount of a bonus, which has pushed you, very close to the higher tax limit. And then you get a mutual fund distribution, even though you have not sold any mutual funds. And then suddenly you are seeing yourself being in the highest tax bracket. Individual investor, you can control it. Flexibility, right? We can be more flexible. Today I came and talked to you about NVIDIA. Tomorrow I can change my mind because I figured something else out, and I'll say, you know what, I'm selling NVIDIA, I'm changing my investment thesis. If we are investing in a mutual fund, if it is let's say a tech-based mutual fund, right? Large cap tech growth fund, XYZ mutual fund company. Doesn't matter how overvalued the tech sector could be, they will still have to invest in tech sector. Or they'll have to modify their investment objective. You have to go through SEC, modify and update all the prospectuses. There is a big regulatory burden to change the thesis. Individual investor, I don't have to think about, I just have to convince myself and change my investing thesis. There's a lot more flexibility if you are an individual investor. Today, if I'm thinking tech is too overvalued, I won't put it in QQQ. But let's say the mutual funds that actually track QQQ, they have no other option. They have to continue put it in QQQ. Alignment of incentive, which is the most important for me. As an individual investor, I will do good when my portfolio is working, but portfolio does good. Unfortunately, that's not the case for a mutual fund investor. The mutual fund manager get compensated not on how much a mutual fund has made money, how much it has performed for their investors. They get compensated for how much is the asset under management. It's an AUM game. Soon you understand that, better will be for you as an investor. It's not the game of better returns. It's the game of what's the amount of funds that I'm managing. So most of them become a marketing machine rather than becoming a good investors. Because if I'm holding $1 billion, I'm getting paid whatever, like pick an expense ratio of, I think on an average mutual fund expense ratio is 1.25. Okay? So I'm going to make whatever, the $125 million, right? Even if the fund hasn't performed. It's an AUM game. But if you as an investor look at your statement and say, gosh, I'm down 5%. But a mutual fund manager made $125 million. That is the whole game. They are being compensated on AUM. I am willing to give money to a financial advisor if they come and tell me that the incentives are aligned, that they will only make money if my portfolio goes higher. I think Warren Buffett did it. There are only very few these wealth managers who actually follow the Warren Buffett partnership model, in which no fee, only performance based. Every financial advisor I talk to, they'll have like 75 basis points will charge. What if I don't make any money? Well, I'm going to still charge 75 basis points. That's not assignment. Our incentives are not aligned then. Right? Skin in the game. For you, it's your own money. For mutual fund manager, it's other people's money, right? Do you think they'll be more careful about your money? No, for them, it's someone else's money. Okay, I didn't perform in 2 years in a row. I lose my job. Fine, I'll go to another Wall Street firm and pick up another job. For you, that's your only portfolio, man. He screwed your portfolio, he moved on to a different job, he continued to make money, and you are screwed. That's the difference between skin in the game. You have your skin in managing your money. They may not. And again, I'm not saying that every mutual fund manager is like that. Generally, that's what I think about, right? Control your own destiny. For example, let's say your mutual fund manager is long-term thinker. You are long-term thinker, and you say, I know that guy, he thinks long. I want to invest in that person's fund. Okay. But other investors may not be long-term thinkers. Maybe other investors get panicked when COVID hit and they withdrew the amount that they'd invested in the fund. What happens? That was the best time to invest in it. So when they withdraw money, there'll be redemptions, requests will happen, the distributions gain will happen, right? So you get hit by the tax. Instead, when the time is best to invest, your mutual fund manager is constrained and is actually selling the fund because the investors are not on the same wavelength as the mutual fund manager is. So you, as an individual holder, is impacted by the actions of other investors who have a different viewpoint. So you don't control your full destiny. Finally, it's a cost efficiency. You have to deal with expense ratios and these are like expense ratios for active mutual fund, which are mostly like tracking indexes, is like 50 basis points. You get into more exotic mutual funds, AI theme based mutual funds, long short mutual funds, or whatever is a new flavor of the month. You end up paying 125 basis points, right? Doesn't look to be a big stuff, right? But I can run the same like long back. I've ran some calculations, right? Over 30-year, 40-year period, you will make 50% less money than if you just choose very low cost ETFs with the same investment objective as the mutual fund. These few basis points compounded over 30 years makes a huge difference. Unfortunately, our brain is not wired to think in compounding terms over a long period. But this 50 basis points makes a huge difference. 75 basis points makes a huge difference. So it's an important, that you pay attention to the cost. And more exotic the fund sounds to be, costlier it would be. Okay. So that's a reason why I think as an individual investor, I don't think that I have a disadvantage. I think I have an advantage over the big money managers because their hands are tied. And I am not tied. I'm not competing with anyone. I'm not tied with anyone else. I'm playing my own game. And then I will structure how I want to play my own game rather than others telling me, you play this way. Dude, I'm not even like built to play that game, right? So are these applicable to index mutual funds? Mutual fund is applicable to all type of mutual funds. Now the index mutual funds will invest in the same stocks which the indexes will invest, but you will do much better by picking an ETF because you don't have to take the distribution tax. Mutual fund structure you will have to pay the tax when the distributions happen, even if they are not triggered by you. You haven't sold any of your mutual fund unit, but the distribution, when the distribution of gains happens, you'll get a tax liability. ETFs, you only get taxed when you sell the ETF. So you can control. Ramesh says most of the managers use same investment based on risk tolerance related to other investors. Yeah. It's incentives are not aligned. But hey, is it better than keeping the money in cash? Yeah. So those of you are just keeping cash, you say, I want someone else to do everything for me. Okay, give it. Better than keeping money in bank account. But I'm saying as an individual, you have a lot more advantage. And if you want to take, take this advantage, it's there for us. We just have to, uh, behave and appropriately. Aditya say, my pension providers don't offer the option hold ETFs. Yeah, the 401ks or the pensions may not have this because that's where they make a lot of money. Do you think it's worth moving money out on separate platform? Does support ETF? No, you move money out of 401ks or the pensions. I think there are tax liabilities. So, but do the best that you can do in those cases is pick up something which is closest to and like low cost and serve your investment objective. There are no, they don't do ETFs because the investment manager has to make money. So that's why they don't have ETFs over there. Okay, last part is the questions for you. Okay, and then we will finish this. I actually went through while I was trying to prepare for options bootcamp. I was trying to get some more information around option Greeks, but then I came across something else. So I thought I'll also play this game with you guys. Okay, so let me just start the poll. So you should see 3 questions right now. Just answer the first one. Don't submit the so which treatment? So there are 2 drugs, for basically using 2 different treatment A, treatment B. Treatment A is increase the probability of cure from 87% to 94%. Treatment B is 94 to 99. Which treatment do you prefer? You see the poll over there, just put it in the poll. Which treatment do you prefer? And we'll come back and relate it to investing / trading. Come on. See the question, right? Which treatment do you prefer? You got a choice to make. Life is all about choices. Investment is all about choices, right? Should I invest in A? Should I invest in B? It's all about decision making. So which one do you prefer? Don't be shy. Come on, play along with me. Number 2, second question I'm going to. Just a possibility. Which scenario would you pick? If you have a scenario A, that your probability of making $1 million is increasing from 0% to 5%. You have a scenario B, the probability of winning is increasing from 5% to 10%. Which scenario do you prefer? That's the question number 2 on your poll. Which scenario will you pick? Will you pick scenario A or will you pick scenario B? That is the question number 2 in the poll. And I have one more question, and then we'll be done with today. Oh, don't submit it. You lost the poll window. Okay. No, there are 3 questions in the poll. Okay, anyway, you play along and note down your responses. Or those who still have poll window can play on the poll. All right. Third question I'm going to ask is, which is potential for 0. Trade A, you have $5,000 investment. Your max loss is $4,500. Trade B, you have $4,000 investment. Your max loss is $4,000. Which trade would you prefer? I'll give you 30 seconds to think about it. And note down for yourself which trade would you prefer. Trade A, trade B. So we have gone through 3 different questions. First one was near certainty. Drug A brings it from 87 to 94. Drug B, 94 to 99. Just a possibility, 0% to 5%, probability of profit, 5% to 10%. Which one would you prefer? Third is potential for zero, which is like max loss, could be 4,500. In this case, max loss would be 4,000. So these are the questions. Okay. Now let's see. I think the whole, the idea of the poll was, and this was conducted by Dr. Jim, was to figure out that sometimes investors may make suboptimal choices because it feels good. So first one was 87 to 94, 94 to 99. Okay, I'm looking at the poll. Majority of you told treatment B, right? And this is what every investor also did, was treatment B, because we like something that we value. We want to be really certain or get more to the certainty, despite the fact that treatment A has more utility value. It increases your probability of profit or probability of fixing you by 7%. Treatment B is only 5%. But treatment B gets us to be maybe more certainty, right? It's a probability, it's not guaranteed. So majority of the respondents pick treatment B, whereas the more prudent or optimal choice would be treatment A, because that increases by 7%. That's got a more utility value. But when it comes to something that we value a lot in our life, which is our life, my health, maybe my portfolio, I want more certainty. And hence, I may be able to choose suboptimal methods, suboptimal drugs, suboptimal choice of investing if it didn't give me some more certainty, right? So that's so most of you chosen treatment B because we are just human, right? I'm not machine, so we think like human. Just a possibility. Let me see how many of you chosen. Okay, so most of you chosen B. Which scenario will you pick? I'm looking at a poll. Most of 63% of you have chosen B. Which is the right thing to do? And scenario A, like 40% of you have chosen scenario A. So the way to look at this is 10% probability of profit. You know, pop is better than 5%. But just when it comes like from almost 0%, I get super excited that I have anyway little bit of a probability of making money, you know, I'll pick that scenario. But the right one would be 10% pop is always better than 5% pop. The last one is potential for zero. This is fun. 40% of you chose B, 60% of you chose A. Why would you do that? Why would you pick a trade wherein you are losing 4,500 over a trade where you can max lose only 4,000? In what world is losing 4,500 better than losing 4,000? Only in our mind, because here in trade B, I'm thinking I lost everything that I have. Dude, but look at, I'm lost only 4,000. I'm not, 4,500 is a bigger loss to my portfolio. But when it comes to potential for zero, we try to avoid, we are, you know, try to pick a lower number. So here I picked a 4,000. Oh, sorry, we try to avoid complete loss. So 4,000 is a complete loss of your investment. 4,500, you feel it is not complete loss of investment, even though this amount you're losing is more than 4,000. So if we have chosen A, that's a suboptimal choice. Why would I do a trade A in which I can lose 4,500? I would rather do B. I lose only 4,000. So, but this is again how our investing mind thinks. And right, this is like a catastrophic loss aversion. I don't want to have a catastrophic loss. I don't want to lose every investment that I've done. We completely ignore the absolute value of the investment here. Right. So right choice is B. But 60% of us have chosen A. That's exactly. Look at the percent loss, 90% versus 100% loss. That's why we're trying to avoid catastrophic loss. But what world losing 4,000 is worse than losing 4,500? I could bring in another trade in which you can lose only 2,000 because that is $2,000 investment you have done. So again, you can have a different thoughts, but this was, I saw it on Tasty Trade. While I was going through, I came across this video. I was trying to figure something on the Greek side. I thought that is interesting, right? Maybe I'll play this here. So thank you for playing along. What was the date? I don't remember the date, but if you go on demand and look for skinny on options, it would have been in like, I think it was on the first row itself. So not going too back. Now I don't remember the date which one was. But it appeared on the first row, so maybe last 4 or 5 sessions. Skinny on options. Sure. All right, so that's the end, guys. Thank you very much. We really ran over time, but I thought it was a fun game to play with. So thank you for playing along. All right, so we're gonna meet on Wednesday for the boot camp. We're gonna talk about portfolio protection, portfolio management using options. Some of the stuff that I mentioned, covered calls, callers, etc. We'll talk about it again. And yeah, so if you're attending option bootcamp, we'll cover that on Wednesday. Otherwise, we'll be here next Saturday to talk about investing. All right. Thank you, everyone. Talk to you later. Bye-bye.